We are now recording. I will admit all. There we go. Good morning, Barry. Morning, Adrian. Morning, Brian. Morning, Chris.
Morning.
Morning, Padraig. Morning, Dave. More people coming in. If you've just joined in the usual fashion, could you mute? That would be great. Fantastic. Thank you. Morning, Karen. Morning, Mark.
Morning.
Yeah, turn my phone off. That would be a good start. There we go. Morning, Billy. Thanks for joining. Yeah, Billy, if you could mute, please, that'd be great. Just to cut out any background noise, that'd be excellent. Thank you very much. Excellent. And yeah. Oh no. Oh. Morning, Gareth. Morning, Mark.
Morning.
Good to see you. If you could
Morning.
mute, Gareth, that would be great. And morning, Mark. If you could mute as well, that'd be brilliant. Excellent. Perfect. Okay. Just coming up to 10:32. Good morning, everyone. Welcome to this week's Coffee Morning with Pension Playpen. Delighted to have Kevin Hollister, CEO of Guide, on here talking about the amazing future of the decumulation market and the staggering 500 billion up for grabs. I'm sure all of you want a little slice of that pie, to be fair, but it sounds quite a headline and quite a big number. We are recording, so Brian, Adrian, Chris, Kevin, everybody happy to be recorded. Mark, if you, yep, that's fine. Thumbs up, we are being recorded. Morning, Bryn. Morning, John. Thanks for joining. So in the usual fashion, we'll open up the chat room. If you want to make any comments in the chat room, then please make a comment in the chat room. And if you want to make a point or ask a question of Kevin, then please raise a hand. And without any further ado, I will now pass to Kevin. Kevin, over to you, and thanks in advance for your presentation.
Cheers, Steve, and good morning to everyone. I'll try and share my presentation to start. Hopefully you can see that okay. I won't be able to see any kind of questions and so forth as I go through it, so just stop me if people have any questions or comments or so forth that people want answered. But so I mean, just to give you a bit of background first of all on Guide at a high kind of level, about 3 years ago, well, kind of post pension freedoms, when advice wasn't made compulsory, we kind of believed that there might be a lot of people attempting to use the pension freedoms without advice, and therefore there would be a need to support these people during retirement and in the run up to retirement, and planning to use those pension freedoms when they reach retirement. And we believed that that had to be done in a holistic way. There were plenty of calculators at the time out there that would say if you've got a pot of X and you get a return of Y and you take an income of Z, then it will last for a certain number of years. But looking at those, we didn't really feel that that was kind of practical for 99% of people. Virtually everybody would have something else, just including the state pension, for example. Lots of people in the current cohort of retirees have got some DB benefits. Lots of people will not retire immediately. They'll do some part-time work. Lots of people have ISAs, home equity, lots of other things that they can use to provide an income in retirement. So we wanted what we were putting together to be holistic. And I suppose one of the aims of it really was to, there were plenty of these tools that financial advisors use, such as Voyant and CashCalc, which are excellent tools in the advice sphere. And we wanted to provide something which was similar to that, but simply enough to use, because, by definition, the non-advised weren't getting advice and therefore weren't using advisors' tools to help them build a sustainable income in retirement. So that was the aim. And talking about innovation today, and at the time, that was quite innovative. I don't think there was anything else kind of freely available to people like that. And at that time, we had absolutely no idea if it would be something where there would be demand for it, and would people be able to use it on their own. And I hope over the last few years we've confirmed that there is a real demand for it. There's lots and lots of people. We get about 10,000 new users a month on next to nothing in terms of a marketing budget. We see 100,000 people a month searching for various terms that we can help them with, and so forth. So there is a huge demand for this type of help for people. And then looking now at so there's been more innovations around that in terms of helping people who are not going to get advice. And now we're looking at kind of further innovations which could come about in the decumulation market itself. So product providers who can do more to effectively help people in that run up to retirement, and then into retirement itself, if they're going to sustain themselves with a long-term drawdown income, or a combination of drawdown and maybe some guaranteed income as well. So that's kind of where we're starting at now, with the guide plan that somebody has built being the kind of fundamentals, if you like, the sustainable withdrawal plan that somebody has, which can then help with the payments that somebody has, and also the investment strategy. So, I mean, we come from the viewpoint that accumulation is easy and decumulation is really, really hard, in two ways. One is, the maths behind accumulation is pretty straightforward. You've got a pot of X, you pay contributions of Y, it gets a return, and you can project what that pot is going to be at a retirement day really quite simply. That isn't difficult at all. Whereas in decumulation, taking down the amount of flexible income you need around all of the fixed parts, the state pension, part-time work, the final salary income that you may have, etc., is a lot more difficult to manage, to be able to work out how that will last, to hopefully give you the total income you need over the whole of your lifetime. But it's also hard from a kind of psychological point of view as well, if you're the end user. When you're building up savings, you're building them up, you're seeing them grow and so forth. But then you've got to change your mindset to, okay, I've built up everything I've got, but now I've actually got to start taking it down, and you're seeing those savings be depleted, and you're worried, will they run out, etc. So one of the main things that people say to us is that, it gave me peace of mind that I could take a certain amount of money, and I would, if things went as expected, then I wouldn't be expected to run out of money over my retirement. And that peace of mind, I think, is really important to people, because it is a kind of huge mindset change from accumulating to decumulating. So why does it matter? Well, in the next decade, we're looking at, there's about 45 billion a year access for the first time. So moving from accumulation to decumulation, the bulk of that goes into some kind of long-term income. There's quite a lot of pots that are taken as cash, but they're generally quite smaller pots. And some people still buy, fully guaranteed income, but a huge amount is going into effectively drawdown of one form or another. So if you look at that, and that number's only going to grow, you can probably estimate that, you're probably going to see about 500 billion of pension pots move from accumulation to decumulation in the next decade. And on top of that, the stark reality is that lots of people won't have enough in pension savings alone to support their retirement income. So there are lots of non-pension savings. We estimate a kind of equivalent amount that will be used to support retirement income. So that could be, ISAs that people have, general investment accounts, just general bank savings, home equity. There are lots of people who I would classify as being quite pension poor, but home equity rich. But all of those non-pension savings, which can be used flexibly, will be accessed as a necessity, alongside pension pots, to provide the total income somebody wants. We've seen there's a bit of a trend for proportion of people going into drawdown who are not advised to be increasing over time, just from the FCA stats that we've seen. I mean, to be totally clear, we are completely pro advice. The best thing that somebody can do is to take good advice, both at retirement and ongoing advice if they need it throughout retirement as well. But the reality is that a large proportion of people are not taking that advice, and therefore they need more innovation in kind of guidance tools like our own and products in order to make decumulation less risky and more simpler for them. So that innovation is needed, and we think especially in payments and investments, and potentially in kind of longevity as well. But I'll come on to that. So can a kind of to and through into accumulation product be more automated? If I go to our next slide, so this is from a video that we did recently. It's just a screenshot, but I mean, essentially, it says a lot of the above. You know, building up and taking down pension pots is a bit like a hike up a hill. You accumulate the pots on the way up, and then you decumulate them on the way down. But where we think the most, where we think the largest potential value leakage is in the period just up to retirement and just after retirement. If you suffer like falling markets, for example, when you're quite young, then it doesn't really have much of an effect because you're making contributions at a lower rate and it evens itself out over time. If you're very old and the markets fall, you're likely to have decumulated your pot to quite a low level at that point, and the percentage fall on a lower amount is going to be less in real terms of an effect. So the key area really we think is that kind of 10 years before, 10 years after retirement, and you can see that from some quite recent examples, people being lifestyled into long-term bonds, as was typically the case, and then when they've reached retirement, interest rates shot up, the value of their pots had fallen quite significantly. That wasn't a problem if they were going to buy annuities, because they would have hedged those annuity pricing reasonably quite well. But the fact of the matter is that a lot of those people weren't buying annuities. They either wanted to take some cash, take their pots as cash if it was a small pot, or potentially wanted to go into long-term drawdown, and moving them into 100% into bonds with a duration of 12, 14 years or so, wasn't the best thing to do. And again, if you're in retirement and you're starting to take down your money, then a large fall in the early years of retirement, I'm sure lots of people will talk about sequencing risk and so forth, but a large fall when your pots are large and you're decumulating money maybe at a heavier extent because your state pension hasn't kicked in and so forth, can have kind of irreversible consequences. So we think that period is kind of key. So what are the three key risks in decumulation? Sustainable withdrawal risk, which is living, which is building somebody a plan, which if everything works out as expected, that should provide them with a sustainable withdrawal plan, which would expected to last. We all know that things won't go as expected. So there's two key elements there. One is to build an initial plan, which is expected to be sustainable and last the whole of somebody's lifetime. The next part is to test that at that kind of initial building stage to see, well, what if X, Y, Z happens? Would my plan still be sustainable? And then if I'm really worried about that risk, should I take some more actions to pay some more in so it would work even if that happened, or perhaps take a bit less? Or perhaps look at other assets as well. Should I need those if that were to occur, such as equity release, for example? And then finally, it's not a kind of one and done situation in terms of you build a plan, but if you do build a plan, that plan should be trackable. You should be able to see, as you come up to and go through retirement, you can refine that as well. To see that plan remains suitable. So if you're if your pots go, so the flexible parts, if your pots and so forth go down, what is the long-term effect on that plan? Do you need to adjust your income, which can be done relatively modestly if you if you're allowing for that at an early stage? If you can monitor that, and it's really simple to monitor that on a kind of however you want, at least on an annual basis, but you could monitor on a monthly basis if you chose to, then that's something which can really help people during that decumulation stage and the run up to retirement, as well as they refine their income needs to be more closely to what they know they actually want. And one of the key things that we think as well, we often, well, we're sometimes told that our tools are potentially too complicated for some individuals, which we don't have that problem with our consumer side, but some people say for our demographics of our scheme or whatever, it might well be too complicated. I mean, our view on that is that if you're going to go into long-term drawdown and you're not going to take advice, then you are going to have to manage your savings for 25 years or so, whilst you're in that drawdown. And if you can't use tools like ours on our own, it's really difficult to see how unadvised drawdown is the correct path for you. You should be looking at getting ongoing advice where everything is done for you, or you should be looking to effectively buy a guaranteed income where you don't have to worry about this ongoing monitoring and managing of your plan. Investment risk. So, as I mentioned earlier, there's lots around investment risk and how that can go wrong in decumulation and in the period up to decumulation. And our view is that you cannot provide a good default investment strategy for somebody unless you know what their withdrawal plan and choices are likely to be. So, to take two, I mean, you can take some extreme examples. Obviously, somebody who plans to buy a guaranteed income would be moved into annuity matching assets up to retirement. Somebody who wants to take cash would be moved into cash. Somebody who wants to take 25% tax-free cash would be moved into 25% cash. Somebody who wants to extinguish their pots quite soon, over 5 years, because they have lots of other things that they can live on after that, will have a completely different optimal investment strategy to somebody who wants to barely touch their pots because they have large final salary scheme or so forth and want to leave those pots to their spouse or their children or whatever. So knowing somebody's plan and knowing somebody's cash flows, if you like, from that plan can provide a much better default investment strategy for that individual. And then finally, longevity risk. There's lots around kind of CDC and so forth, which I won't go into, but there are other ways to pull longevity which can be done, and it can be done on a much more simplified basis, we think, in order to protect people against longevity risk and effectively give them those survival credits in later years. So it doesn't effectively matter if they live way beyond the average. The survival credits effectively boost their income by or boost their pots by such an amount that it doesn't become an issue. And one of the key parts around that is if you're going to introduce any type of longevity pooling, then you need to obviously restrict people's income that they can take from it, because you've got the selection risk of somebody who falls into poor health wanting to withdraw their pot. But if somebody has an original plan, it is much easier to do that in terms of you could let people deviate from that plan by a certain amount and therefore reduce that selection risk. But you don't have to make it so restrictive, i.e. a person can withdraw their plan however they wish to. It's a deviation from that initial plan because of new known information, which causes the selection risk, not the actual plan itself or the pattern of the cash flows. So automation. So we are starting to announce now that we're about to launch a decumulation product with two partners, a pension provider and an investment manager. And this will provide, from our part, an initial sustainable holistic income plan. Nobody will be able to enter this product unless they have a sustainable plan, which they've worked out on Guide. That plan will then provide a set of long-term cash flows that will be expected to be withdrawn from the pension pots. The pension provider will effectively pay those when somebody comes to retire. The pension provider will pay those regular monthly payments that the individual wants. Those payments don't have to be the same in each month and so forth. And they will be paid up until the end of the next tax year. At the beginning of the new tax year, or in March each year, the person will be able to review their plan, see if it still looks sustainable over the long term, over 25 years or so, or their life expectancy, basically. So, and then look to review that plan each year. So they can either continue with the plan as they wish to, as they originally had, or they can change it if their pots have done better than expected or worse than expected, or so forth. There is still full flexibility. Ad hoc payments are available, and kind of better than that, you can model the ad hoc payment. So if somebody says, I need an ad hoc payment of £10,000, you can look at, well, what if I take a payment of £10,000 next month, how does that affect my long-term plan? Is it still sustainable? We did a lot of polling with users to find out what was really important to them, and we were quite surprised that about 95% of users said what is really important to me is that the immediate cash flows or the immediate payments that I expect to get are stable. They care far less about money in the future at age 85 and so forth. They would rather, and they may not be being realistic about it, but this is essentially what the feedback was. They would much rather that the cash flows from, say, age 65 to 75 were really stable and almost guaranteed. And they can't be made fully guaranteed, obviously, without a kind of term annuity. But they would like those to be much more closely matched. And they are less worried about having to reduce their income in later years. But if they do match a period of cash flows, so let's say we give them the option of 5 to 10 years of how long they can match, they can do that on a rolling basis if they wish to. So each review, if you've put in that you want to match the next 10 years cash flows, you can do so, and then that would automatically come down to 9. But if you want to continue it on a 10-year rolling basis, you can do so. So you can just move it out to 9, out to 10, sorry. So this, in a way, provides a seamless kind of to and through approach to retirement. If you're 5 years away from retirement, well, let's take if you're 10 years away from retirement and you've matched 10 years of cash flows, then your cash flows in the next 10 years are 0. So effectively, you would be in 100% growth type strategy. As you get 5 years to retirement, the first 5 years would now start to come through in your more matching investments. And as you get to 0 years to retirement, you would have the next 10 years matched. So you're gradually moving into that matching of cash flows, and therefore gradually going from a more growth type of focus strategy to an element which is matching those near-term cash flows. And it also then, if you do it on a rolling basis, provides more security of income at older ages. As you age, let's say you get to age 80 and you've got 10 years life expectancy, obviously your life expectancy is pushing out as you survive to a certain age, and you've matched 10 years of cash flows, then those 10 years of cash flows become a lot more certain. You would get to a kind of 10 years of matching 0 years of growth portfolio at that kind of age. So in providing that, in doing that rolling term, you can see how it works, or it could work quite well up as you go to and through into retirement. And then when you're in retirement, it would gradually de-risk as well, assuming you kept that rolling period of years going. And then finally, it can be combined with a longevity pooling at a later stage. It wouldn't be in our V1 product, but you could see how if a number of people had built plans come into that product, you could start to look at broadening their longevity as well if it had, enough kind of consumer volume and so forth in order to do that. So that is slides are quite a high level overview of what we're trying to do, and it's probably a good time for me to stop, take any questions, go into any more details, etc.
Yeah, thanks, Kevin. That's a very interesting presentation. There's a few statements and questions in the chat. So, John, do you want to unmute? I mean, you've just put a little comment there, John Mather, about who's going to take responsibility. John, do you want to unmute and sort of make that statement or ask that question?
Yes, I mean, what I've said in the chat is when somebody tells you they only bother about income from 60 to 70, who's going to get that person up and tell them the bad news that if they don't do something, they're going to starve to death? I mean, advice is about bad news as well as good news.
Somebody has built a long-term sustainable plan. As I said, that's a prerequisite for coming into the product. So you've got to have a plan which would be expected to work given our life expectancy assumptions, which are reasonably prudent. So somebody coming in at age 60, they could only come into the product if they've got a plan which is going to, provide no shortfalls up until 89 or whatever that is. But what you can say is, so let's take those. Let's make it easy. There's 25 years of cash flows. Let's say the life expectancy is 85. That individual is matching, if they choose to, matching somewhere. Well, they'll have to choose between 5 and 10 years. If they match 10 years, then the investments backing those 10 years of cash flows are on a much more matched basis than backing the later 15 years of cash flows, which are on in growth type assets.
You okay with that, John?
Not really. I think sometimes clients need a bit of a waking up at times, because they tend to ignore inflation, they forget the buying power, and they totally underestimate their longevity by about 10 years, in my experience. So
yeah, but they won't be able to. So we built a plan for somebody using quite prudent actuarial assumptions. Let's say that they're 60. It says your plan, you will need a plan which lasts at least, I don't know, I'll make it up, 30 years, because we've assumed that you're going to, your average life expectancy will be till 90. Now, when that person's 70, we don't assume that their life expectancy is 90 anymore, because their actuarial tables, it will say that their life expectancy is now 91 or 92. So effectively, by building that plan and continually monitoring the sustainability of it, they can see if there's any shortfalls over their life expectancy. If they get to age 90, it's not going to be, oh, you've suddenly run out of money. By the time they were 85, it would probably be projecting that they would live till 95.
yeah. Okay.
Okay, John. Billy, you got your hand raised, and then we might come to Gareth, who's made a comment as well. But Billy, do you want to go first?
Yes, rather than write a note, I can understand the logic of what Kevin's saying. I think in practice, people have other resources, and a lot of people sort of have simple sort of jam jar mentality. I'll use my pension pot up to a certain age. If it's looking dodgy, I've got other assets, to call upon. So I can see the logic on that. And I think the difficulty in all of this is, and Kevin, alluded to it, that the difficulty is to get people to think, long term. There's a lot of, sort of emotional behavioural stuff in this, and people are much more concerned about the short term than they are the long term. So anything that can get people to look at the longer term, is obviously very good.
I think it's good. A couple of the kind of, I understand that there will be kind of challenges to this and so forth, and nothing is risk free. You're providing a long-term income to yourself through, one aspect of that income is non-guaranteed drawdown income. What I'm saying is ignore advice. The best thing everybody could do is go off and get advice. But in the real world, people aren't doing that in sufficient numbers. So compare this as a product versus at the moment somebody muddling through year by year, not knowing what to do. They're not turning to an advisor, and they're winging it effectively to see, how much money can I take. And I could give two there's two types of examples. You've got your person who will take way too much money. It doesn't matter what investment return they're going to get. They don't have a sustainable withdrawal plan. But you've also got the person who's got a decent sized pot, but is so scared to start taking down, drawing down their money and seeing that pot depleted, that they live quite a kind of frugal life, when in reality they probably, don't need to do so. So it's almost I know people talk about risk, but it's almost a relative risk of, what's out there in the decumulation product market at the moment for people who don't take advice that can help them, in this kind of form. I'm not seeing a lot of, my own view in terms of innovation, to help people along those lines.
Okay with that, Billy? Okay. Nick, you've got your hand up. If you want to unmute, Nick, and ask a question or make your point.
Oh, hello. I'm a bit of a newbie to pensions, but Guide, this may sound a bit of a strange question. Guide, are you sort of a provider like Aviva or Legal & General? Does that make sense?
No, so we are effective. I'm an actuary by background, and I do kind of maths for a living that other people don't want to do because it got kind of boring and not the most interesting stuff in the world. So so my contribution to all of this is to effectively do the maths for people to say, if you take X amount of money each year, you should have a sustainable plan. Now that X won't be the same in each year. If I retire at 65 and I want £20,000 a year, to keep it simple, I'm going to need £20,000 plus whatever I need to pay the tax to get that £20,000 out. When I'm 67 and I've got my state pension coming in, I need to take less money. Or if I'm working part-time and getting £5,000 a year from that time, I need to plug the gap somehow. So what Guide does is effectively take the flexible parts, both pensions and savings, and puts them all around the fixed parts to give you your total income that you want. So if we come back to that £20,000 a year again, if I've got pensions and savings, what I want to do is I want to take £12,500 from my pension pots. I can get that out tax-free because there's tax-free allowance, and I want to take £7,500 from my savings if I've got some savings, and then I take £20,000 and I don't pay any tax at all. That's the kind of calculations that Guide does. We are not a pension provider. We are integrating with a pension provider, a SIP provider with a few billions of, I can't name them at the moment, but a few billions of assets. We'll integrate with that. That SIP provider will say, right, okay, here's your plan. Here's a plan that you've agreed with Guide. I will pay you those monthly cash flows up until the end of the tax year. At the start of the new tax year, you can review that, and I'll continue to pay you what you wanted in the next tax year, or you can change it if your plan is less sustainable or not sustainable, or your circumstances have changed, you need more or less money or so forth. That's effectively what we do. The pension provider does, and then the investment manager says, I'm going to take those cash flows that I know that, or I expect that you want, and I'm going to put you in there's only one choice of investment strategy, but that investment strategy will be tailored to both the cash flows that you want and the number of those cash flows that you wish to make more secure.
Thank you.
Thanks, Nick, for your question. Adrian, you've got your hand raised. Do you want to ask a question or make a point?
Yeah, thanks, Steve. Firstly, Kevin, well done for reaching out and helping the non-advised. I think it's going to be the vast majority of retirees, and they really, really will need some help. I also think you're absolutely right to be trying to look at to and through retirement, because maybe that can help to spread the decision and reduce the sort of cliff edge decisions that people otherwise are faced with at the point of retirement. Now, I come to a number of these meetings, and quite often at this point, somebody says, well, what we really need is deferred annuities so that we could buy a deferred annuity on the sort of way through life before we get to retirement. But you can't buy a deferred annuity unless you're the trustee of an occupational pension scheme. Insurance companies won't sell them to individuals. I think it's because they are very, very expensive. But I'm left thinking that perhaps that is a role that CDC will be able to fill, because a CDC style deferred annuity would not suffer those same capital issues that an insurance company suffers from. We should soon get some more CDC schemes launching, as well as the Royal Mail scheme, which takes on its first members in a couple of months now. So is there a role for individuals to move some of their money during the later years of the accumulation phase into a CDC scheme in advance of then retiring from that CDC scheme at their retirement date and taking a CDC income stream throughout their retirement? And so sort of blending, a bit of money in CDC with a bit of money remaining in growth assets, and can the guide tooling, cope with that sort of idea where you've got some money in income streams that might be CDC, but also some money remaining in growth assets?
Yeah, so I mean, if I talk about if we just call it guaranteed income, for want of a better word, so if you can get guaranteed income through effectively through CDC or or via annuity. So our modelling tools, if you've got a plan that works, our modelling tools would say, so you built a plan, it looks sustainable and so forth. We would say, would you like to use 25% of your pot? So we try and keep things really kind of quick and easy for people to understand. Would you like to use 25% of your pot to buy a guaranteed income? So we have annuity rates that come from us from Retirement Line, whole of a market broker, and someone can see, very quickly, if I was to use 25% of my pot to buy some guaranteed income, then use the 75% in drawdown, would that potentially still work? Now, obviously, they've then got to go off and get actual quotes based on their health and so forth, but we're kind of quite prudent in the quotes that we kind of show, and we have a kind of just a quick health questionnaire as we go through and kind of do the life expectancy. But that is one way, and then people can model anything later on after they built a plan, up to 90% or so forth. But so that's one way of having it as a slice of income throughout retirement. But the other route is that, if you're continually monitoring the plan that you have, you will have a certain pot value. And if that certain pot value can then buy you 100% guaranteed income, and I don't care if that's from an annuity or CDC, CDC could probably buy better terms at say 75, then people can make that decision of, well, I don't want to stay in drawdown anymore. I can quite happily see I can secure an income for the rest of my life, X amount, which is enough for me to live on. If it's CDC or it's annuity, great. At the end of the day, that person gets a guaranteed income for the rest of their life.
Adrian, you happy with that answer?
Oh, fantastic. Thanks, Kevin. Yeah.
Excellent. Okay. Gareth Morgan, do you want to unmute? Actually, Brian, you put your hand up, so we'll go to Brian and then we'll go to Gareth. So yeah, go on, Brian, you go first.
Oh yeah, thank you. Yeah, really good, Kevin. Thank you very much, and thank you for kind of contextualizing it, that it's actually not for people who should be taking advice, who will take advice. It's for people who should be taking advice, who won't take advice. So I think we need to look at it in that vein when we're doing our comparisons. There was a couple of questions asked in the chat. One was, can you do it for a couple?
So that is, it's funny enough. That is the most answered question, requested upgrade to our site that we have had. And we've had quite a lot of other stuff to do. And we've always been promising that we will do it. We're now at the point of we've scoped it out of how we're going to do it. And yes, you will be, by the time we launch the product fully, we're hoping that you will be able to do it on a couples basis as well. So effectively any drawdown pots, any drawdown income coming from your husband or wife, that can be part of your overall plan. And if your husband or wife wanted to take out this product as well and get paid that automatically, etc., then yes, that's something that they could do.
Do your assumptions assume a rising income that maintains parity with inflation?
So my my answer to that would be I don't know what inflation is going to be in the future. So effectively, people get to choose between a flat income,
Yep.
an income that rises at 2.5% a year, which is anticipated to try and keep pace with inflation, or an income which rises at 2.5% a year to age 75 and then goes flat.
Yep.
And that, if you take out any kind of health issues or care issues or so forth, that is a kind of typical spending pattern for a retiree. We're all going to spend less probably when we're 80 than what we are when we're 65. Stripping out inflation.
Does it assume FCA mid-range growth using the provider's own charges?
Again, what we look at. So if you ask somebody to estimate what growth they may be able to achieve, so what we do is we say if you took a reasonable medium risk strategy which might be suitable for drawdown, you could probably expect to get somewhere in the region of between 4 to 6% with a midpoint of 5 after any charges. So a kind of 50% bonds or 50% matching, 50% growth type strategy, given where risk-free rates are at the moment. Now, people can change those. People can move the slider to say, no, I expect to get, say, a 7% return. If they do that, then our system automatically changes to, well, now you're taking higher risk. Yeah, and that higher risk can either be you're taking a higher risk investment strategy, or that medium portfolio would be expected to get, say, 5% on average, and you're taking a higher risk that you're not effectively going to achieve that because you're looking for some kind of additional growth. So what you can't do is say you can't press the button low risk and then put in a 7% return. It'll just automatically move you to
so basically uses common sense assumptions, and if it doesn't look right, then it says no, you can't do that. Does it prompt you, let's say that you have a 20%, 25% loss, and therefore the assumptions are perhaps a bit optimistic, sequential risk, does it then prompt you to say you need to review this?
So what I mean, that would come through as part of the kind of experience. What it does at the initial testing stage is it tests 4 scenarios. So those 4 scenarios are: you get 1% less return than what you've put in on average over the whole period. You live 3 years longer than what's expected. There's a 20% hit to your pension pots and savings pots just after retirement when they're the largest, and you need some care for the last couple of years of your life. So kind of scenarios that people can understand, quite sort of simply. So effectively, if you look at that and the test page and it says your plan won't work if there's a 20%, we call it market crash. Your plan won't work if there's a market crash. You can either say to yourself, right, I'm going to take that risk, that I'll take the risk that there is a market crash, or I'll reduce my income, or I'll pay more money in, pay more contributions, so that even if a market crash were to occur, I would still be expected to have a long-term sustainable plan.
And is it software, or is there any human intervention as well? Is there access to a helpline or a bot or anything like that, or is it once a year you get some sort of printout? What's the sort of the human intervention, if you like?
Yeah, so effectively that's on when somebody so nobody can come into the product unless they built a plan. So in building the plan, they build one sustainable, everything goes as expected. They then test it against a number of kind of assumptions, and then they can alter it should they wish to do so. And let's say, okay, that's great. I've looked at all of this. I can see that guide, the product linked to guide can really help in my decumulation or so forth. So I'm going to go into that product. I'm going to consolidate my pots. I'm going to go into that product. You don't have to consolidate all your pots if you don't want to. I'll come on to that in a minute. But you can you can do that. So effectively, that individual would then every tax year, so once a year, can review their plan, or would be expected. We will be prompting them to review their plan to say, right, okay, these are the pension payments that you're going to get for the next tax year. Review your long-term sustainable plan. Do you need is it still sustainable? Do you need to reduce it slightly? And if you're going to see shortfalls, you would be seeing them probably in, say, like years 27, 28 and so forth. And you probably only have to adjust your income, a small amount to make,
Yep.
27 years away to make those red bars go away.
Sure.
Yeah.
Thank you. I have got other questions, but let someone else have a turn. Thank you. That's really good. Thank you.
Okay, thanks for that. Adrian, you got your hand raised. Nick, you still got your hand raised, so that might be an old hand. But Adrian, you go first.
Yeah, I wanted to come back and challenge Kevin. I hope challenges are allowed on this forum. But Kevin, I wanted to challenge you. It was almost a throwaway remark that you made there that, of course, by age 80, we'll all be spending less adjusting for inflation than we do at age 65. Because there's a really important paper that was put out by IFS, Institute for Fiscal Studies, just 2 years ago in 2022, written by their economist Rowena Crawford. And it was based on the ONS longitudinal data as to what our pensioners doing. It's called How Does Spending Change Through Retirement? And amazingly, it shows that we spend more at age 80 in real terms than we did at 65. So spending through retirement goes up at about CPI plus 1% up to about age 80. And then it decreases a little bit in real terms, but not in absolute terms. It continues going up in absolute terms at about CPI minus about 1 after age 80. So this old view that I think a lot of people in pensions hold, that, well, of course, as we get older, we get less active, we don't spend as much money, is not actually true. The data shows the reverse. Pensioner spending increases faster than inflation.
Okay, I mean, I've sat on the Institute of Actuaries and various other kind of studies around that, and there's probably some kind of conflicting data. I did say that if you strip out health and care issues, so I don't know how much of that extra spending may be to do with kind of potential health issues or whatever. But I suppose the bottom line for us is, if somebody wants to have an income which does increase by 2, we don't know what inflation is going to be, but tries to keep pace with inflation at 2.5% a year, then that's a shape of income they can model in Guide. They can model a flat shape. This is total income as well, not just what's coming from your pension pots, or they can do the kind of up to 75 and then flat. And you can also you can change any year to whatever you want. So you can model any shape of income that you wish to do within Guide, total income that is. Obviously, with the fixed part, such as a state pension and so forth, like if you took a flat income, for example, you would actually be taking a reducing amount from your pension pots each year, because your state pension would be paying more and more of your of the total amount that you need. So yeah, it's completely variable. It's completely up to the individual. We just give people 3 kind of basic shapes and explain to them what the potential risks of each are and the potential benefits. You can get a higher starting income with a flat income, but you run a really big risk of your purchasing power going down over time.
Oh, I'm glad I can cope with it. If I can find the link, I'll pop it in the chat. But it's really important for customers to understand that most pensioners are actually going to be increasing their expenditure as they go through retirement, and people ought to understand that and plan for that.
A fair point, Adrian. Fair point. Chris Giles, you made a couple of comments in the chat. Chris, do you want to unmute and just talk about the issues you've raised there, Chris?
Right. Can you hear me?
We can. Yep.
Right. I think those who follow me on LinkedIn will know that for some time I've had this view that the way we should be doing DC pensions is we shouldn't be converting pots at 65. We should be setting up our retirement income at 55. So basically where I'm coming from is the safest way, and of course for many years it was difficult because bonds were yielding 1%, albeit equities were yielding 4%, or equities in the UK. Now we've got bonds up at 4%, as well as you can generate safe income at 4% from equities as well. So that's the sort of level where you can predominantly, certainly around the period of retirement, for the first maybe 10 years, let's say you were drawing down at 5%, you can take 80% of that straight away on a matching basis. And that's where the industry needs to move. In other words, people need to be holding income units, not accumulation units, particularly in retirement.
Yeah, and that's exactly what we've said. So the individual can say, I want to match a period of years, And how you match that, you could, in one sense, you could have a bond ladder, where you bought those 10 years of you effectively fix those cash flows for 10 years with bonds, and if you hold them to redemption, you're going to get the the exact return that you're going to get. So that's effectively what we're kind of doing, and say portfolio, that will kind of fluctuate. It doesn't really matter what happens to, if you're doing it on that kind of cash flow matching basis, it doesn't really matter what happens. If you hold them to retirement, that's the return you're going to get, and as long as they don't default.
And the other advantage of starting 10 years early, of course, is if you're in investments that are yielding 4%, you don't draw down that income, you reinvest that, and therefore your starting yield at retirement is, of course, somewhat higher.
Yeah, so there's effectively two ways to kind of make those payments. One, as you say, is through yield. If you've got a certain element of that portfolio that's creating a yield that can produce that income, then that's great, irrespective of the value. The other is to to have those investments mature at exactly the right time. What I suppose what I'm looking at is, if you look at a lot of default investment strategies, I've named some of the big players out there, that their default investment strategy effectively goes to 60% bonds and 40% equities at retirement. Kind of seems fine, but those bonds have got a duration of 12 to 14 years. And if as we all saw, when interest rates went up, the value of those bonds collapsed at just the time that people were looking to take income from them. And again, I'm trying to compare what we're trying to do with versus what is there in the market at the moment, and to me that just seems kind of fairly nonsensical what was there.
Kevin,
Yeah, the
sorry.
market. I'm
Yeah,
going
go
to say
on,
the
Chris,
market basically doesn't, at the moment, doesn't cater for what I'm proposing, and essentially it doesn't, because it's built on the wealth management. The investment management industry is a wealth management industry focused on total return growth all the way through, including retirement. It's not interested at the moment. It needs somebody to get interested in actually matching cash flows and income to provide people with stable income, rather than worry about legacy. Fine, those who've got 500,000 plus, they can happily not draw down and pass it on. But for the mainstream market, with much, perhaps 100,000 to 200,000, who might want to generate an income, the earlier they start, the better.
Yeah, I mean, our average pot users have 250k in pension pots, and they probably have about 50k in kind of non-pension assets as well. So that is the kind of market that we are looking to to help. For them, you're probably talking about people going to advice are probably more the kind of 500,000 mark and so forth, but there are lots and lots of people who are, say, over 100k, so they've got enough to provide a sustainable income if they manage it rightly, but probably not in the sort of bracket where they're going to be able to find advice readily, or look at that cost of that advice and feel that it's kind of good value compared to the sort of size pot that they have.
Kevin, can I just make a point? Sorry to interrupt, Chris, but
It's
isn't
all
there
right.
isn't there a mismatch here between the wealth management SIP sort of side of the business and the occupational pension master trust side of the business? Because a couple of times it's sort of 5-10 years out from retirement has been mentioned. So the concept of a default fund, as you said earlier, Kevin, is broken to some extent, because if you've got 1 million or 2 million customers, how do you create a bespoke default for 2 million customers? Because for half of them it might be right, half might be wrong. Is there a mismatch, do you think, then, in the way that trustees of master trust, for example, do their pre-retirement default funds? How can that be fixed?
Well, I suppose, I mean, if you look at it kind of objectively, I mean, effectively, if you look at the trust-based market, you've either got single trusts, and I don't know of I think there might be one or two, but I don't know of any real sort of single trusts that offer decumulation anyway. So if somebody wants to go in decumulation in one of those trusts, then they're going to have to basically transfer out to a retail product. My understanding is that a number of master trusts do offer decumulation, but also it's my understanding that 99% of people move their assets out at retirement with those master trusts. So effectively, the one place that you can go at the moment for a decumulation product, as far as I'm aware, is pretty much the retail market, because it's not really serviced by the by the trust based market. But as you say, it's a really good point. If you've got X million customers, you can't devise a default to and through investment strategy, because it could be completely different for different people. So it comes back to that kind of fundamental point of, you can't build a default investment strategy for any individual without knowing or having a good idea of what they expect to do at retirement in terms of tax-free cash, the age at which they expect to retire, how they expect to decumulate over retirement, do they expect to buy some guaranteed income. I suppose one of the benefits of Guide is that it gives you all that information on that individual, because they've laid it all out for you. And then once you've got those cash flows and those other known instances, you can create a much better investment portfolio for them.
Okay, interesting answer. Yeah. I don't know whether John or Brian want to comment on NS&I. There's a comment in the chat regarding issuing an RPI linked annuity. I mean, would that work, Brian? Or
Well, I just don't think they will. I mean, I think isn't one of the problems that we're all seeking an investment that gives what we want, and there's no such thing. So what we're trying to do is to fudge around what people want is a guaranteed, or what many people want is a guaranteed index-linked income that they can leave to their children when they die. No such thing exists. So given that there are lots of competing demands, what we actually need, and I think well done, Kevin, for having a really good stab at it, is a tool that people who don't want to take advice for whatever reason. I was a financial advisor for 25 years, and yeah, I wish they'd use me, but even I can't help them, because I don't know as an advisor what the right investment strategy is. So we need, I think Chris Giles is it sort of said, we need workplace pensions to do this and have this kind of strategy. There ain't any. There isn't actually an appropriate investment that definitely works. So if people don't want to secure their income with guaranteed income permanently, there's always going to be a conflict between people wanting certainty and yet wanting flexibility. So, and as that sort of dynamic keeps changes, and as inflation changes, things go up, things go down. If we're trying to do it without an advisor, then surely this kind of tool is designed to help people make less bad decisions when they haven't got a coach to help them. And I don't think there are any NSI tools investments out there that can actually give you the solution you want through an actual investment. So we're just all approximating.
But that's why you have to invent it. If the tool doesn't exist today, it doesn't mean to say it doesn't exist, that it couldn't exist.
The investment
and you've got to find a matching problem, because really what you're trying to do with any product is to determine who's sitting around the table who's taking the risk. Right? Now, if you've got a large institution capable of taking the risk and therefore probably capable of honouring its promise rather than defaulting at some point, then who is the ultimate person to take the risk? Well,
that's an annuity. That's an annuity, but they don't pay the rates that people are looking for, so people go away from the annuity.
But suppose the annuity is provided by the state through NSI. The debt management offices have enough problem rolling over gilts at the moment, but they want something that actually defaults contractually, like an annuity defaults contractually. So at least you're getting rid of debt, and not making sure the balance sheets of insurance companies is bigger. So there are solutions if you can define a strong enough partner to take the risk. We've done it before. The trouble is, if you start producing solutions that are innovative, the FCA shuts you down, because now my client base, and I had 50 years of doing this in central London. My client base finished up as sophisticated high nets only, because that was the only one where the business case made sense of giving advice. Because I was taking on, a 500 fee for moving a couple of 100,000 of pensions across, and taking on a potential 200,000 plus liability at some point in the future without any limitation of time, which just doesn't make any sense, which is why we're down to 37,000 advisors from 300,000 over the last 20 years.
Yep.
So, you've got to come up with something that really makes sense. And I do think that state-sponsored annuity, suppose you forced everybody to buy an annuity up to providing national average wage, for instance, or the living wage, and then you could do more exotic things beyond that, right? That would focus people's minds and put the risk with the community that could afford to take the risk. The higher nets with the people with multi-million-pound funds. And there are enough of those, about 1% of the population. But they could then pay and subsidise the rest of us. You've got to find somebody to take the risk. We've done it before and we've produced exceptional returns. But the only way we could get excess returns and alpha into the situation was to leverage. But leverage is frowned upon. But it could actually be the route to the right risk taker. But
Okay, John. I appreciate your comment.
What do I know? I just know how to fail consistently for 50 years.
Okay, Chris Giles, you got your hand up, and that'll probably be the last question. But Chris, do you want to just make your point, or?
Yeah, it's just on the bonds. In fact, I'm just finishing something in the chat. I'm trying to push the new government. I don't know if you caught up with this, Stephen. I did something on the subject of dual bonds. Nobody's picked this up before. We've had people like Aaron with his selfies and these deferred annuity bonds. But if you just look at the standard gilt or any standard bond, what is it a combination of? An annuity income bonds and a zero coupon bond. Seems ideal. The zero coupon bond you could have for 20 years if you had a 20-year gilt, and the matching 20-year zero coupon bond would be your longevity pot.
There you go. So we should get Aaron back on to help Kevin's case. Is that right?
Well, I don't know, but it's a question that they've all gone on holidays. But in September, I'm hoping to give it a push. Brilliant. I don't know if Bryn's on is Bryn still on the line? I don't know whether Bryn would have any comments, whether it's something that government might pick up.
Bryn was on, but I think he may have gone now. But yeah, he is.
Right.
He was on.
Follow it up with him.
Follow it up with him. Follow it up with him. Kevin, at this juncture, I'm going to say thank you very, very much. It's good to see that you're doing something about this issue and this problem, and it's coming. So we need change. So virtual claps, everybody, if we can clap for Kevin. And great session. Really, really appreciate that. If anybody wants the slides, please contact me, and I'll be very happy to send you the slides. And so, Kevin, fantastic. Next week, we've got David Fairs talking about the DB funding code. So I'm sure everybody will be really interested in the DB funding code with David Fairs, especially as ex-TPR, as we all know. So, but great session, Kevin. Thank you very much indeed. Enjoy the rest of your day. Today's video will be up on the website later on this afternoon, plus a podcast. So when you're in the gym, Brian and Adrian and Chris, then you can you can listen to the podcast. So there we go. But Kevin, thanks again. Really appreciate it, and enjoy the rest of your day. And let's pray for peace in the East. So a really great session, and thanks everybody for joining. And see you on the next occasion. Thank you very much indeed. All right, cheers, Kevin. Thanks very much.
Cheers.
Cheers. Bye. Bye.